Welcome back to our investigation of finances. We are already negotiating the challenging terrain of cutting dividends in 2024. Even if the year is only getting started, we already have to deal with a big development, a well-known corporation cutting its payouts by 48%. Please remember to hit the subscribe button and give us a thumbs up for additional financial tips before we get into the specifics. Let's analyze this developing narrative now. The investment community was shocked by unexpected news in the first few days of January when Walgreens, WBA, a major player in the market, announced a significant 48% drop in its dividends. The market was rocked by this disclosure, which caused many investors to reassess their holdings. Just a few weeks prior, discussions were already circulating about Walgreens' uncertain future. The company was at a crossroads, with questions looming about whether to buy, sell, or hold positions. The anticipation for the January 4th earnings release was palpable, and when it finally arrived, it brought both positive and distressing news. Walgreens revealed a mixed bag of financial results in spite of the turmoil around the dividend decrease. Positively, the company showed amazing growth in revenue and sales, rising by 10% in just a single year. With revenue projections smashed by $1.6 billion, the corporation proved its dominance in the U.S. and foreign farm industries. But the sharp drop in dividends from 48 cents to 25 cents cast a shade over these accomplishments. The stock fell 7% as a result of this action, aggravating the situation for investors who had anticipated a more gradual or postponed correction. In order to comprehend the reasoning behind this dividend cut, we must examine Walgreens' financial accounts. The corporation stated that the main goals were to secure long-term cash flow and to strengthen its financial sheet. Redirecting the funds that would otherwise have gone toward lower dividends will allow Walgreens to make strategic investments in its shops, especially in specialty pharmacy sectors. Walgreens' leadership emphasizes the company's dedication to keeping its dividend yield competitive. They maintain the dividend's crucial position in WBA's overall investor appeal, notwithstanding the reduction. As the news broke, Walgreens shares fell 6.8% in the first reaction of the market. What's interesting, though, is how the investment community has responded. Analysts' observations and observations from comment sections indicate that Walgreens' stock had already been priced in for the dividend drop. The stock fell 7% in reaction to the cut, even though it had dropped more than 30% over the previous 52 weeks. The difference between the expected and actual effects highlights the market's flexibility and resilience, since it seems to have taken this development into account well in advance. Investors are currently debating the million-dollar question of what to do with Walgreens in the wake of this dividend cut. A crucial component of financial planning is the decision-making process, since personal portfolios took losses and some people are carrying more weight than others. Following this financial crisis, investors' focus is directed toward adjusted profits per share, EPS, a crucial indicator. Adjusted EPS takes into consideration a variety of expenses, providing information about a company's financial health. This becomes especially important when assessing a stock in the midst of a dividend cut, such as Walgreens. Investors weigh more factors than only price when making a decision. Real-world observations, such as the deserted Walgreens storefronts, provide the analysis further perspective. These observations add to the overall comprehension of the company's performance, even though they are not the main factor. The yield becomes a crucial consideration in the pursuit of optimal decision-making. The characteristics of income creation change as a result of Walgreens' yield falling to 4%. This opens up additional investment opportunities for investors to consider, such as substitute assets like SCHD ETFs. The value of group intelligence becomes clear as the investing community analyzes this incident. This dividend reduction is just one more thing for investors to learn on their continuous journey. Even though they are not inexpensive, every cut teaches important lessons that support the market's resiliency and growth. Comments Turn become a forum for discussing tactics, insights, and experiences. With their Walgreens shares, what are other investors doing? In what ways are they adjusting their portfolios to deal with the changing financial environment? The sharing of investor experiences and insights highlights the communal nature of investing. As we wrap up this discussion on the first dividend cut of 2024, the focus shifts to the future. The world of investing is dynamic, and each development, no matter how challenging, propels us forward. While the pain of a dividend cut lingers, the community anticipates more financial insights in the coming days. The story of Walgreens serves as a reminder that perfection in investing is elusive. No investor is flawless, and the market is unpredictable. The key lies in learning from every cut, understanding the market's responses, and evolving as investors. To sum up, 2024's first dividend cut heralds a year of financial catastrophe. Walgreens turns into a case study, a section in the Investor Experiences book. One thing is guaranteed as we proceed through the highs and lows of the journey: the investing community's ability to withstand financial storms. What do you think about the dividend reduction at Walgreens? In what ways are you modifying your investment approach for 2024? Please share your thoughts in the section below. Recall that each market movement represents a step in our group's financial journey. Keep checking back for additional updates, and happy investing till the next time.